tried doing is breaking our lectures into smaller bites, if you will. So I'd appreciate any feedback if you think these 13 to 15 minute ones are better than a longer one. Hey, we talked about equities. Let's move on and get a little more deeper into fixed incomes or bonds. Within the financial markets, there's more bonds and fixed income than there are equities. It's a big area, and many people are involved in the bond business. First thing we should talk about is it's based on maturity, remaining maturity of the loan or the bond. And I use those words interchangeably. Short term is defined as anything less than 5 years. Medium term is 5 to 10. Long term is greater than 10. One of the things that I think is important to understand is the price behavior of a bond. It moves inversely to the interest rates. So if we have increasing interest rates, bonds go down. If we have declining interest rates, bonds go up because they're always a constant yield to maturity. So you can see that if the interest rate moves, the premium and or the discount expand based on the time horizon. So you look at 20-year bond is really going to lose more value because you're always going to be yielding the current market. So this becomes an important thing, and I think it may be a question on the final. So keep it in mind. The next thing that we look at with bonds is not maturity. Okay, it's duration. And duration is a different measure. It rolls up several bond characteristics into one, the maturity and the coupon. It really identifies how sensitive a bond's prices relate to changing interest rates. The shorter the duration, the less sensitive or move less than somebody with a high duration. For example, if rates were to change by 1%, a bond with a 5% 5-year duration would lose about 5% of its value. Okay, so this is where we're seeing in the market today, we're seeing interest rates on the bonds, what they're yielding to you, go up while the value of the bonds go down. Now, if you hold a bond to maturity, you don't need to worry about these up and downs that happen because you're going to get paid back if it's a $1,000 bond at the end of the period, you're going to get paid the $1,000. But it always is essentially marking them to market based on the current yield to maturity. Within a portfolio, and that's what we really manage, when you have money, you're managing a portfolio. And that is an amount of assets, and you don't want to have them all in one asset class, any one size, any one sector, any one company, because you want to minimize that volatility. So you need a strategy when you're managing an investment portfolio to have a strategy or an approach. First is you identify your goal. How will you know if you're successful? What is the criteria you will use to select investments? And when will you sell the investment? Many investors are good at identifying a goal and selecting an investment, but a lot of people struggle with selling an investment. And that is either selling a winner, because if you have a winner, you keep hoping it's going to go higher, or if you have a loser and you really have hung on to it, you believe in the company, you hold on too long. But that's the harder part. You can't just trade stocks or invest in stocks without a strategy. You've got to have that strategy, what your goal is, when do you buy, when do you sell. I struggle with this all of the time. I get excited about different things. Oh, I got to buy that. Whoa, or this one doesn't look good. I'm going to sell it. Without really taking the time to say, does it reflect the strategy that I want to do? Does it reflect what I'm trying to achieve? And that is where we start with in a portfolio, is aligning the goals and the risk and determining what allocation you will into the different asset classes. And if you have a long-term horizon, you can take more risk because you know over time there's a higher return. And that comes back, if we can just flip back here. If we just flip back we can see that there's this variation here. So on a long-term basis, we know it's going up, but there's more chance of this movement. So if we have a longer time horizon, we can invest in more stocks, take more risk, because we have a timeline to make it up. So when we look at any 10-year period, we do see that it consistently goes in term, average risk, average return. Short term, lower risk, lower return. So it's a matter within a portfolio of when are you going to use this money? When is it for? So if you're saving for retirement, you as individuals are looking at a 40-year period. And if you go back and look at that chart over 40 years, it's going to keep going back up. You might have that. But if you're saving to buy a car in 3 years, you can't afford to take that risk. Okay? When you build a portfolio construction, every asset has the level of risk and volatility. Don't ever forget that. Every asset. And if you have one asset, your risk is concentrated. If something happens to that and it blows up, you're going to lose money. Or it could just be a home run and you can make tons of money. Most people don't want to take that concentrated risk. You want to reduce risk and volatility. Remember, there's a slight difference there. And that's achieved by diversifying across asset classes. So diversification from a pure definitional perspective is the act of investing in a variety of assets rather than just one or two. A diversified portfolio has less risk than any of the ones alone that you select. So that's important that when we're building a portfolio, and we can be building a portfolio for ourselves for retirement, we could be doing it for our company using our excess cash, for nonprofits, for endowments, many, many reasons. This chart is one that most people, and I'll say every one of you, won't believe. Okay? And every time I look at it, I don't believe it either. But when you look at this, and this is here, what defines the portfolio performance? 91.5 is how you allocate your assets. So if I have $5 million, how I allocate them, whatever my return is going to be based on these allocation decisions. Stock selection, only 4.6. Market timing, getting in at the right time, 1.8. Stock selection is only 4.6. But yet, investors spend a lot of time on this and don't generally spend enough time on this. Okay? And that, for those of you that are involved in Smith, this is what we're going to be focusing on next year, is how do we make better asset allocation decisions to get the portfolio to produce. When we have it, the asset allocation is how do we mix all these things together that I talked about based on your financial goals, the time you have to invest. You have 30 plus years before you're going to ever think of it. I maybe have 10 at the best case, okay? But yet I intend to live into retirement, so as much as I intend to live off my investments sooner, I still need them to last another 30 years, okay? And that takes into account your risk tolerance. If you're taking personal finance with me in the fall, we're going to spend a lot more time on that. Here's a couple of strategies that people use, and it's cash, fixed income, large cap equities, small, medium, small, international. Now what we saw is over time, small caps clearly outdid the large cap with more volatility. But what you can see here in a conservative portfolio, a lot of it is fixed income. It's not going to generate a lot. You move up to this aggressive, which is going to have a lot of international. It's going to have a lot of the small and mid cap. And it has the potential over time to generate a significant return. Okay, are you confused yet? This is not an easy topic. Most individuals don't have the time or knowledge to trade or invest individual stocks. If they have the time, they may not necessarily have a large enough portfolio to be diversified. Now, things have changed over the past 50 years, 40 years, 30 years, 20 years, 10 years, 5 years. And we have a lot more tools available to us, but we also have a lot more information coming at us. So around 40 years ago, there were a lot of people who wanted to invest for their future. However, they didn't have the time or knowledge. And that's when mutual funds were developed to help individuals who don't have enough to diversify and don't have the time nor the knowledge to be able to invest. A basic mutual fund structure is you have mutual fund shareholders, that's you and I. Investors purchase shares in the mutual fund. The money managers, those managing it, select and purchase securities, and that results in a diversified portfolio. That's the basic structure of a mutual fund, and that's been around for 40, 50 years. Some things you should know about them: they're bought and sold daily, based on the value at the end of the day. You don't buy mutual funds until the end of the day. So what the mutual fund does is you put an order in before 4 o'clock, they close the market, value all those, and determine a net asset value. You always buy and or sell the net asset value at the end of the day. You may not always know what you're paying until after you buy it. Oftentimes funds have, as they grow, they can't manage the money as effectively to take it in. In the mutual fund business, many numbers of them. The big ones are Vanguard, T. Rowe Price, Fidelity, Schwab. There's thousands of them. And that, when we look at it, is a way of how the individual investor has been able to participate in the market and still have diversification. A couple of things about them. Cost influence returns. These are not the cheapest to these are not the cheapest to run. There's something called a load versus no load. Load means there's a sales charge. You're paying somebody for the right to buy it, or you're paying them to sell it to you. No load means you're not paying a sales fee. Today, I don't know why anybody would pay a fee to buy a fund. If you see one, run away. There's no performance difference between whether you pay a commission or you don't. But that first year's performance is reduced by the sales charge. We then have 12B1 fees, which are marketing fees for the fund. Management fees, you pay the advisor to manage the money, to develop the strategy, to determine what to do. We have transaction fees, clearing fees, accounting and legal fees. So that's mutual funds. When we look at it, mutual funds are rated on performance by Morningstar. And Morningstar ratings are sort of the standard in the mutual fund industry. And what they do is they look at a risk-adjusted return. So they're looking at what the performance is relative to the risk. We'll talk about that as we continue to move forward. But what you see is that if it has a 5-star, that only goes to the top 10%. 4 stars, 22, 3 stars, 35, 2 stars, 22, 10. So this is essentially a bell curve. Now remember, past performance does not guarantee future performance. But if you have a strategy that works, there's a probability that it could continue that. But you don't use it. This is just a measurement of past performance. They'll rate it for 3 periods: 3-year, 5, and 10. So it's an important thing to pay attention, especially to as an individual